Welcome to The Explainer. So there's this famous rule in finance, one that millions of people have used to plan their entire future. But what happens if that rule, especially for a country like India, isn't a golden ticket, but more like a trap? Today, we're going to tear down the 4% rule and see if it's a guide you can trust or a myth that could seriously hurt you.
I mean, it's a tempting idea, right? The thought that just one number, one simple rule, could sort out your retirement for good. You wouldn't need any complicated spreadsheets or sleepless nights. And for decades, that's exactly the promise people have been sold.
And this is it. 4%. For years, this has been pitched as the magic number for retirement. The basic deal was this: follow the rule, and your money should last you for 30 years. Now, this whole idea was cooked up using US market data, but it spread like wildfire all over the world, including right here in India.
Okay, so what exactly is the 4% rule? Well, the way it works is actually pretty straightforward. In your very first year of retirement, you take out 4% of whatever you've saved. Then, every year after that, you take out that same amount, just with a little extra added for inflation so you can still buy the same stuff. The whole point is to give you a nice steady income for 30 years.
You know, there's a technical term for this, the Safe Withdrawal Rate, or SWR. It's kind of the holy grail of retirement planning. The 4% rule is just the most famous version of an SWR, and it basically became the default setting for financial advice everywhere. But, and this is the big question, does a rule that was built for the US economy really make sense for India?
Well, that's precisely the question a brand new research paper set out to answer. It's called Balancing Acts, Safe Withdrawal Rates in the Indian Context, and it puts the 4% rule under a microscope, specifically for India. And let me tell you, the results are a major wake-up call.
The researchers, they don't beat around the bush at all. They come right out and say that trying to use this rule in India is just, quote, not appropriate. And why is that? Well, because pretty much everything is different here. We're talking higher inflation, markets that behave in their own unique ways, and a tax system that can really change the game for your investments.
Okay, so if 4% is the wrong number, maybe even a dangerously wrong number for India, what's the right number? What should someone actually be aiming for if they want a retirement they can count on?
Now, to figure this out, the researchers didn't just pull a number out of a hat. No, they did the heavy lifting. They ran thousands of simulations, using decades of actual Indian market data, crunching the numbers on stocks, fixed deposits, inflation, the whole shebang, to find a rate that's actually based in reality.
And this is what they landed on. For a safe 30-year retirement in India, you need to be way more conservative. We're talking a range between 3 and 3.5%. Now, that 0.5% difference might not sound like a big deal, but trust me, over 30 years, it could be the difference between living comfortably and running out of money way too soon.
And this table right here, this shows you exactly why that tiny difference is so huge. Just look at the risks. If you stick to that old 4% rule, the data shows there's a 25% chance you'll run out of money. I mean, that's a 1 in 4 gamble with your entire life savings. But just by dropping it to 3.5%, you almost cut that risk in half. It's pretty stark when you see it laid out like that.
So, this all leads to a pretty obvious question. Why? Why is the number so much lower for India? Well, the study points to a couple of key culprits. Think of them as two hidden villains that can sneak up and wreck a retirement plan, especially here.
The first villain is something called tax drag. Here's the deal. In India, you pay taxes on your investment gains before you account for inflation. So, when inflation is high, you could be paying tax on growth that isn't really growth at all. It's just inflation. The second villain is sequence risk. That's just a fancy way of saying you have really, really bad luck. It's when you retire and bam, the market crashes right away. The timing of that is just devastating.
And look at this chart to see how nasty that tax drag can be. Just imagine someone who put all their money in safe, fixed deposits, and they're pulling out 3.5% a year. If there were no taxes, their chance of running out of money is almost zero. But you apply a pretty standard 30% tax rate, the failure rate explodes to over 60%. Your safe plan just became almost a guaranteed failure. That's crazy.
And here's how that bad luck, that sequence risk, can absolutely destroy you. Picture it. You finally retire, pop the champagne, and in that very first year, the stock market tanks. But you still need money to live, right?
So you're forced to sell your investments when they're at their lowest point. That just rips a hole in your savings that's almost impossible to climb out of. The study showed this one event can basically doom a portfolio from the get-go.
Okay, so after hearing about these retirement villains, it's pretty easy to feel a little defeated. But the good news is, the research doesn't just point out all the problems, it also tests some solutions. So how do you actually build a portfolio that's tough enough to survive all this?
Well, the study looked beyond the usual mix of just stocks and bonds. It brought in an old Indian favorite, gold. The thinking here is that gold often zigs when the stock market zags. So when your stocks are taking a beating, gold can act like a stabilizer and cushion the blow.
So this is what that tougher portfolio looks like. The researchers suggested taking some of the money out of stocks and putting it into gold, creating this three-way split. And guess what? It worked. The simulations showed that adding just 10% gold to the mix actually made the portfolio safer, lowering the chances of it failing, especially in those riskier scenarios.
All right, so let's tie all of this together. What's the final blueprint? What are the big takeaways for planning your retirement in India?
So what does this all mean for you? First off, forget the 4% rule. Anchor your plan in a safer reality, somewhere closer to 3 or 3.5%. You absolutely have to plan for those villains we talked about. That tax drag on your fixed income is a real killer, and so is the risk of a market crash right when you retire. To fight that, think about diversifying with something like gold. And maybe most importantly, you got to remember that a retirement plan isn't something you set in stone. It's a living thing that you need to check in on and adjust as you go.
At the end of the day, this is why research like this is so critical. It forces us to question these old, comfortable ideas and pushes us to build smarter, more realistic strategies. So the question it leaves us with is probably the most important one you can ask yourself. Is the plan you have for your future built on reality, or is it built on a myth?